Okay, so I didn't have much notice here that I was doing this, so I figured this first episode would really kind of kick off the idea of what this is going to be moving forward, sort of the goal of what kind of questions to bring, what you might want to ask in future episodes. So, what I want to do is just kick this off by saying one of the things I get.
Sort of the goal of what kind of questions to
Oops, sorry,
bring,
I'm
what
having
you
a
might want to
background
ask.
noise here. Sorry about that, team. So, one of the big things I've been noticing is the amount of questions inbound in and around how to get started, where to get started, why I haven't started yet, what kind of money do I need, how do I get financing, how do I decide where to market, where do I decide how to jump into real estate. What a lot of these questions are really speaking to its scale is a general, hey, Big Ray, how you doing? One of the big things I think that I'm seeing out there is people in general have a lot of fear in terms of getting involved in real estate, whether it's buying your own home or rental properties or commercial real estate or getting into the debt side of the business. So I really wanted to take a break from my normal channel, which is really talking about overall personal finance or stocks or more complex things like options, and really take the time out on Sunday mornings to really jump into real estate and what's happening in this space. So I want to talk about a few things right off the bat, a little bit about my experience and background, because I think most people who watch my channel on YouTube know me for the stock side of things. But the reality is I'm much bigger on the real estate side. It's just I felt like there are a lot of people who talk about real estate online, and I want to maybe not step on those toes, but I'm not hearing what I wanted to hear after now some time. So I figured I'd give another start here. Um, the goal of this is not for me to jump on and talk at you. The goal is to have Q&A. Eventually, I'd love to have the ability to sort of jump on or dial in. Hey, Amit, thanks for joining. The goal here is to really have it be based on questions and answers. And over time, once I get better at this and figure out how to do it, I would love to be able to take live calls, things like that. Let me take a full stop for a second. And Drew, I already see your question. I'm going to address that in a second here. But for anyone who's joining here for the first time, my name is Sean. Yes, I run a YouTube channel. That's not what I do for a living. I work in things like analytics and data. But my real background and my heavy background is really in the realm of real estate. So I want to give you a quick little background of sort of my experience level in this space so you can have some confidence, at least in the reality of the fact that I've been doing this. First and foremost, I'm not a CPA, I'm not an attorney, and I'm not an agent. Okay. So the reason I'm calling those things out is you will always need those things. Those are important things. Those are things you want to work with from a professional perspective. But much of the challenge of getting involved in this is getting past sort of the mental fear, the concerns, the confusion, the what do I do next, all that kind of stuff. So I want to give you a quick background on myself in the real estate space. And I think a lot of people probably will be surprised to hear some of this because I mostly talk about stocks. So I figured I'd start at really the baseline here. Number one, like a lot of people, I've rented apartments. I've been through the process of what those documents include. I've read every single page of them over the years. I know the struggle and the stress of having that side of it. But I've also rented commercial property for my businesses in the past. So I'm familiar with the terms, the leases, the lengths, how do you get those done, how you work with property managers and owners from the side that's actually renting. So I've owned both office space, commercial space, and light manufacturing. I've rented all of that. In addition, I've owned several multiple personal homes over the years. So I'm very familiar with the process of not only buying a personal residence, what goes into that, what to expect in the process. But also, I've done things like owner financing. I've negotiated those terms with attorneys. So I've experience on that front as well. I currently own and manage a portfolio that's primarily built up of single family rentals. They're spread throughout the United States. I'm also the CEO of United Comfort Homes. I almost never talk about that online, but I figured I'd throw that out there today. Now, I also partner on larger deals where I come in as either the financing or expertise and will share in larger deals. I'm also an LP or a limited partner in some other structured syndicate style deals. I also am currently the owner and managing director of a real estate fund where we invest nationwide in single family homes. In my previous younger days, I was also a licensed loan originator, and I specialized in things like mezzanine, bridge, and commercial debt for complex real estate process. So, financing rather. I've also flipped homes, and I've even worked on the construction side of the business. So the reason why I wanted to share all of this is because if you know me as Sean from Invest to Live, who does a lot with stocks and works in that space, for sure, all of that is accurate. I do have a huge life in that world, but really, real estate is my home. Real estate is where I really do my thing. So I thought this would be a great way to share some expertise and some knowledge, sort of from the full 360 of what's included here, how it works, and all those great things. First thing I'm going to throw is a quick thank you, Amit, calling out here. I did just hit 4,000 subs. I have no idea how that happened. I really appreciate it, team. And I really appreciate the support. I know a lot of folks who are on here right now are people I love to interact with and interact with on a regular basis. So what I really want to do is answer some actual questions. If this is a 5 minute or 10 minute first episode, that's totally cool too. I'll keep it that way. But Drew actually has a specific question here, and I think this is really important for a lot of folks who are trying to get into the space in and around real estate, not sure how to get started. So the big question that Drew has is, how much should you have in reserves for repairs? Is there insurance that covers that? And is it worth it? So I had a feeling this was going to come up. So I actually work in the way that I structure things within my business. And this is really the way that I go about this on a day to day. You have to treat this like it's a real business. This means you have numbers ahead of time. You understand your ratios. You know what you're looking for, how you're going to spend, and how you're going to distribute income when it does come in. So, Drew, I'm going to speak to a couple of different ways that I break this down. I'm going to first and foremost say, though, that it is very conservative. And what I've learned in going through 2001, then 2008, and then just recently with COVID and all of the things like rent moratoriums and all of these kinds of things, one thing I've learned to do is be very, very conservative with how I structure and manage what I pull out and where I put it. So I think there'll be some people who think this is probably a bit too much, but this is really geared more towards the beginner who just wants to make sure they're covering their rear end. So Drew, here's the way I look at it. So I treat this full blown as an actual real business. I do this through my fund and then also through my overall company. When I get my gross, right, let's call that 100% of the gross money that comes in for rent per door. I'm assuming, depending on the number of doors, I have a property manager in there that's going to be around 10%. As you grow your portfolio, that number will keep going lower and lower. I'm seeing more and more people now structure that as a fixed dollar amount versus a percentage. But just to keep this simple for the conversation, I figure about 10% of that gross is going to go to a property management fee. 5% I take out towards taxes. 5% I take out towards vacancy. 5% I take out towards CapEx. And 5% I take out towards maintenance. Now, when I say I take them out, what I mean is in total, if you did the math there, that's about 30% of my gross comes out right off the bat, 10% to PM, and 20% to, again, taxes, vacancy, CapEx, and maintenance. Now, the reason I decided to break this up a little bit more than the average is it has to do with how quick I might need the money for the kind of repair or emergency I'm up against. When you reach a certain size, you're going to have, like, we have our Amex cards that we can easily use to fix whatever we need to do, whether it's a door, a roof, or a mailbox, which you wouldn't believe how many mailboxes I fix. It's actually mind blowing when I think about it a year. The reason I do it this way is I take that 20% and I actually put it into a relatively safe fund with a wealth advisor. And the goal there is just to keep it somewhere where it's going to be relatively steady, have a tax advantage, and also have the ability to grow over time, but I can easily access that money whenever I want. So when I think about those four categories, taxes are obvious, right? I want to have that somewhere where I can get to it whenever I need it. Vacancy is really just making sure that if there is a period of time where I don't have someone currently renting that door, if there is a mortgage or anything due on it, I have that vacancy coverage to pay for that over that period of time that it might be vacant. The CapEx is really where I focus on big things, right? This is going to be the roofs, the windows, the basements. If there's something majorly structurally wrong with the home, if I have to replace appliances, things like that, I like to use a separate category for that. Just from a mental breakdown perspective, it all ultimately goes in the same place in the way that I do it. But I like to mentally think about how I'm peeling that off and how I'm tracking against that over time. And maintenance is really just the things like if I have to get in there and do a cleanup or a clean out, if paint needs to be redone, if there's some little things here that have to be taken care of. Now, what I do want to take sort of a little break from and explain also is it's not indefinite. I'm not going to indefinitely keep adding to this until it's a point where, like, I'm sitting on, six figures for a house that maybe only cost low six figures. Typically what I want to do is have somewhere between, like, we'll just call it around 15K for a reasonable priced home, where I now have that sitting there and available to cover anything that might pop up there. That money is sitting somewhere where it is growing or earning some sort of return. So I'm trying to double down on the investment from that perspective. So Drew, I know you're driving, so hopefully that helped answer the question. Excuse me. I want to share this too. So Rizzy, of course, with love and catch up, and I can appreciate that. Just looking for a house to live in. Do you think there'll be a better time to buy? People seem to say 6 months would be the best time. So, yeah, man, I get this question all the time. And even when I was working within the loan space, which was actually right going into the crash in '08, I didn't do much residential work. I was primarily really on the commercial side of things. But we always had people coming in with questions on the residential stuff. And even at those insane, I'm going to give you the same thing I would have said back then is the same thing I'm going to say right now. The very first thing you should be doing is going and getting a pre-approval letter, something you can have in hand. So if something does hit the market and you can get something to live in, you're ready to rock and roll really quickly. And at a minimum, you can start to shop that around to get better rates. So I want to talk about the pricing and the 6-month piece, but just first and foremost, you should absolutely go and get pre-approved, understand what you can afford, what you can get with your down payment, and then what kind of amplification you can get if you save a little bit more, if you lower a particular credit card or a car payment or something like that from the standpoint of a debt to income ratio. Here's the thing on like the 6 months thing or whenever it's going to be. I think depending on who you talk to, it's going to really dictate what you're seeing as far as, is it 6 months? Is it 12? Is it never going to happen? Have we already contracted and this is the most we're going to see? I think assuming you've got that approval in hand and you are serious about looking in the near term, I think there's no reason why you can't start to look around now. And I'm not a fan of like these YouTube famous lowball offers. I think no one ever actually closes lowball deals. It's just people like to talk about it because it sounds like it's pretend. One thing to think about is if you didn't want to wait 6 months, assuming 6 months is even the timeline, let's just say you didn't want to do that. You can think about how you structure the deal in a way that becomes more beneficial to you than just a lower price. So when I bought the house that I'm in right now, when I bought this, there was a lot of competition to buy it. And when I came in, it was sort of exactly what we were looking for, the right size, had all the space we needed, all that kind of good stuff, good school system. I talked to the realtor who was selling it and I said, listen, is there any way possible, and this is not normal, by the way, but it says, is there any way possible you would let me talk to the owners of the house? And if not, can you pass on a message from me? I said, what if instead of buying the house and putting 20% down, what if I bought the house, put 10% down, let them hold 10% of the mortgage at a slightly higher interest rate, and then I'll get the other 80% from the bank. And so they will not only get their full asking price that they're looking for, but they'll actually earn a little bit of extra interest on that second loan. So I'm not saying you should do this. What I'm saying is you can get really creative in how you structure the deal. So it might be that you can come down and say, look, prices are going to come down. Here's my proof based on comps. I want to buy this house, but I need it for 5% less than asking. Or maybe you bring it down and say, look, I need it for 10% less, but what I'm going to do is can I offer you to hold a second loan so you get not only the original price that we're agreeing on, but you'll earn some interest on a portion of the loan as well. So there's a lot of different ways to think about how you structure a deal like this and how you can potentially get a better rate that's almost meaningless in your monthly payment when you really think about it. You're just giving them some extra incentive to do a deal with you and work on that price. For years, I had heard all kinds of stories about owner financing, how people are doing it, how they're getting it to work. And I sort of was always like, I've never really seen it, only a few times. I did it myself. It 100% worked. It was the easiest thing in the world. You're going to have your attorney anyways. They're going to have their attorney. All you really have to do is go to your attorney, explain what you want for terms. They're going to write it up. It's a really simple process and they'll deliver it to them. And if they agree to it, it's a great deal. And sometimes that's a really good way to lower your price point while not really increasing anything extra. And you're going to put less out of pocket. So all in all, you sort of can win in a number of ways. But again, it starts with having a pre-approval and knowing exactly what you can buy and what those numbers are. Because I'm going to throw a random number out here. I have no idea what your numbers are, but assuming you're at I'm just going to throw a random number, 300K approval, right? That's what you can buy. You've got money down for 300K. You go and look at a home for 320 and you tell them like, look, I love this home. This is the home I want, but I can only do 300K. How do we make this happen? Sometimes that's a good way to build in some downward pressure on the price right from the get-go, especially if homes are sitting in the market for longer periods of time. So what I would suggest is this, just to sum it up. I'm not saying home prices won't be cheaper in 6 months because I don't know. And frankly, no one knows. But even if they are, there might still be amazing deals you can get now before everyone and their mother and their uncle is out there looking to buy the same homes that you're looking to buy, which means a lot more competition, a lot more stuff to deal with. So hopefully that was interesting. And I'm going, obviously I'm working by myself, so I'm going line by line here in the comments. So team, I apologize if I'm not getting to you quick here. I promise I'll get back to you. So Big Ray has a question. Don't know if you have time today. Well, I sure do. But after I buy my next property, I'd like to get into bigger projects, 10 plus units. Any tips or advice? It's I think the biggest challenge with 10 plus units is finding deals here because you're not going to really negotiate price. It's going to be based on cap rates. Okay. So the first thing you want to do is understand in the area that you're looking at, in the type of 10 unit you're looking at, is it like an A property, a B, a C? What kind of a neighborhood is it in? You're going to want to understand what are the typical cap rates within the area you're located in. And then, what will that mean for a price on your property? Because cap rate dictates the actual price. It's not the other way around. A lot of people get this wrong with commercial. And I'm not saying you don't know this, but if all the 10 units in the area are going for a 5% cap, so you're making what, 5% on it, and you're looking for something that's different from a price perspective, you have to have a different reason for this. So my only advice here is work with a commercial broker who really understands the market and be really clear on how you're going to manage this. Because when you go to the bank, I don't know, of course, Ray, I don't know your background or what you own today, but a lot of banks are going to want to, first of all, make sure you actually can do this. You have the money to close, but this isn't like buying a regular property. When you're getting a commercial loan for this is going to be a commercial multifamily, they're going to want to see not only do you have the money down, which is minimum 20%. Nowadays, I'd say probably 25, 30 to be safe. They're going to want to also see typically like 3 to 6 months of reserves ready to go just in case you have problems when you move in. The other thing to consider too is really price in repairs and really price in property management here. Even if you're thinking about doing it yourself, it still might be worth looking into those numbers ahead of time. Those are the things I would do first. And then what you're going to want to look into is what commercial brokers are doing deals right now for the best rates. And of course, it's going to be non-recourse, which means, there's a thing called a DSCR, debt service coverage ratio. They're going to want to make sure that your DSCR not only covers all the bills and expenses and mortgage, but also has another buffer on top of it. So the bigger of a buffer you can get in your rents to your expenses, the more likely it is you're going to get the deal done. And at some point, experience becomes a diminishing piece of this, as the ability to service debt with extra money in the bank is going to be that much more valuable to you. So Ray, hopefully that was worthwhile. Happy to go deeper as well. Dima, this will be on YouTube for sure. So all questions are legit questions, but I appreciate you calling it out. So how do you calculate returns on investment properties? Yeah, so there's a lot of different ways to look at this. There's cash on cash, there's net on investment, there's return on investment, there's internal rates of returns. If you're new to the realm of investment properties, I think sometimes just the easiest way to think about it is like, if I'm investing 100K and after everything is paid, said and done, I'm making, $100 a month. So I make $1,200 a year. So it's like 1.2 ROI. I think that's the easiest way to think about it. Is if for smaller properties, I'm looking more in terms of immediate ROI. I could do a whole entire show on like all the different metrics, and if that's helpful, I'll do that. I don't want to go down all the different myriads of them, but the same way you think about it is not any different than you look at the ROI for anything else. The difference with real estate, though, is you can look at how you buy it, and that will determine a lot of how you're going to look at the returns. It's if you're paying cash for property versus if you're putting 20% down versus if you have some sort of like 203K renovation loan. Like there's a lots of different ways to think about how to calculate the return based on how you buy the property. If you buy straight up with cash and you pay $100,000 and you net $3,000 a year, you're making a 3% return on that investment. But if you only put 20%, if you put 20% down on that $100,000 property and you're in for $20,000, but you're making $3,000 on that, well, that's a massive return cash on cash. So it's important to understand that the way you calculate returns is going to be on how you ultimately buy the property. So a lot of people look at things as being, on a cash on cash comparison. But again, I think that's a really great question, and one that probably deserves like a full 30-minute breakdown of all the components and some math behind it. And I'd be happy to do that as well. So Amit, let's hit you, buddy. If you had 100K, would you put a down payment on a property or invest in the market? Whew, man, I'm sure everyone, I'm sure everyone is going to hear me say this and be like, we already know, but I'm going to say it anyways. Absolutely, I'm not giving financial advice here, okay? These are two totally different things. I think the answer is going to be really, really obvious once I say it out loud. It depends what you can expect to get for returns on that 100K. If you believe that the market is way down right now and that you can get into quality companies and see humongous upside, then you need to compare what you're likely to earn on that versus what you might earn in real estate versus investing in Audia, as Big Ray says in the next comment here. Um, my general thesis is that this is just me, okay? I use real estate as the baseline of my entire portfolio. And then next in my sort of order of operations is the general stock market and where I put things there. And the reason for this is I like the way real estate works because not only can I have someone else help to build my wealth by paying off my mortgage in terms of rent, but I get monthly income and I get overall appreciation over time. Now, with the stock market, the most comparative way to look at this is if you're using margin, right? You're borrowing money from the bank, you're looking for an arbitrage opportunity between the rate you borrow and the rate you earn, but the risk is really high there too, right? So for me, you have to think about it in terms of how do I multiply and maximize my money in a way that's going to give me an outsized return. I I don't think one is better than the other. I think you have to compare what the opportunities are at any given time and what you're available to compete with and manage in your time. If you're brand new to real estate and you don't feel confident you can have the time to manage it, get construction crews in there, have a property manager, all that kind of stuff, I think that maybe for a lot of people it's easier just to get into the marketplace. But I think the real kicker here, and most people, uh, the first time I met someone who's really wealthy, I'll tell you a really quick story here. I was working in loan origination. We were working on the paperwork for, I forget the exact number. It might have been 100, 120 condos. This was right in Boston, like primo real estate. And this guy drives up wearing like head to toe, like Kmart brand sweatpants, sweatshirt, no socks, broken shoes, the whole shebang, right? Sneakers were falling apart. And the guy who owned the office I was working in immediately got the door, sat him down, cup of coffee, the whole shebang. And he's like, "Hey, Sean, you're going for a ride." So we jump in this truck. It's falling apart. We drive down, and I'm thinking like, I don't know what's going on. These guys don't waste their time, and I don't ever judge anyone based on how they're dressed or anything. But this was so out of place for where we were, right? It just something didn't feel right. So we ended up going to these units, which were stunning. I mean, like absolutely stunning. And lo and behold, he's the developer. He's developing all these properties. He's in the process of selling them. They actually wanted me to come in and help them with some of the financing stuff. That's a whole story for another day. The point that I want to make was the my boss texted me, guess his net worth. And of course I have no idea. I was like, I can't even guess. And he said 50 million. And that was the first time I had really been that close to that kind of wealth. And so he did it as a joke because they were going to tell me about it anyways. But we had a nice conversation, and it speaks to the question, Amit, that you have on the screen here. And I said, well, what's your secret to getting to that level of wealth? He said the secret is to find ways to multiply your money in safe ways and find arbitrage there within. And it became so obvious to me from that moment forward that real estate was the way to have that massive leverage where other people pay your debts for you while you get the gains on both the rent over a year-on-year basis as well as the appreciation. Now, of course, everyone can argue, well, what about vacancies? Well, we already answered Drew's question that we're protecting ourselves from vacancies. Okay, what about when the markets crash, like we might see from a previous question as well? Well, again, the markets might go down and might constrict, but if I'm in them for the long term, then I'm okay. And when they go up, I'm always able to sell at any given time I want as well. So the long story short of the question is, if I had 100K, what I would do is look at where my best opportunity is right now and assess how long I can be in that opportunity to get those long-term gains. I think that there is a big difference between being a retirement millionaire and being a 30-year-old millionaire or multimillionaire, whatever the number or metric you're measuring is. So it's a great question, but it's going to really come down to the math and what the opportunity is in front of you to do something with it. Sorry, I'm just going through the questions. They're coming in way faster than I can move. So I just want to make sure I double down on this question. So D, I think I answered this already, but I want to double it down. You really have to take a little bit of time and put it on an Excel sheet and look at it and say, look, in the market, I think I can get a 12% return, right? I don't know, maybe it's 5%, maybe it's 15%, but call it 10 or 12, right? Will that 10 or 12 outpace the return I can get on a cash on cash basis by buying real estate with a loan from a bank, looking at appreciation over a period of time as well as rents over time? Those are the kind of baseline comparisons. So just want to call that out. I think that's how I would do it. Rizzy, another question on down payment. Do you think it's better to keep in cash or invest in an index fund? Whew, man, these questions are so awesome. I'm actually like psyched. I was really concerned, I'll be honest with you, team, of like, what if I get one question, then I just kind of cut it right at the beginning. This is a great question. And I get in my daily real world life, this is asked to me by almost everyone under the age of 30 that I meet who wants to buy a home. They're all saying, like, I don't want to stick it in savings. What if something happens? Blah, 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 blah. And what the real root of the question is inflation is high. I'm losing value on my money. If I keep it in cash, is this going to hurt me? During the most recent bull run where we've had really low inflation, really low interest rates, questions like this are really important because you don't want to lose the value of your money. Where we're sort of in now an increasing rate situation and we're seeing prices level off or come down because interest rates are going up for homes, I think that there is a way to think about cash in a way that's not just actual cash. If you're legitimately looking at buying something in 3 months or 6 months, and you just want some sort of return, you can go to your bank and ask them if they can do a 1, 2, 3 month CD. You're not going to earn much on this thing. It's going to be like nothing, but rates are going up. So maybe you can get it into like a 3 month CD. It's totally secure, FDIC, the whole shebang, right? See what they can offer you for a rate or see what an online bank can offer you. It's going to be totally secure. You'll get it back in 3 months, earn a little tiny bit of interest on it. Maybe that offsets some of the inflation to some degree. I know I'm being realistic. It's not a lot, but that's one way to think about it. That's beyond just cash or a savings account. So I would look into things like CD rates that you can lock in for really short durations and then have access back to that money. And what I would also do, to be totally fair, is be honest with them and say, look, I might be buying a personal residence or investment property, whatever the case might be, in 3, 4, 5, 6 months. There's absolutely no reason why they can't tell you, like, hey, look, if you were to try to pull the money out early, here's the penalty you pay. Just find out if there's a penalty. There probably is, but maybe it's not enough to even be concerned. So that's myself, what I would do and how I would think about it. Okay. Hopefully that answered the question. Um, Dima, I sort of was expecting this question. And it's a really, really, really fair question. How do you compare a rental property, as an example, to a stock like Palantir that's growing at 20+% per year? Um, I'm going to answer this question with a question, and I don't expect you to give me an answer, but just for everyone who's watching to think about this. If you were in Palantir at its highs and you now are sitting near its lows, you've lost a ton of money. So the question is, how long and how many years of 20+% returns will it take to get back to where you were without any income coming in from it, and without knowing if it's going to be 2 years, 3 years, 10 years, or ever that you see those prices you might have already bought them in at. So I think that you have to also we're really getting into like the depth of investing here, which I personally love. So this is great for me. What you really have to look at now is not just rates of return, but overall capacity of return and drawdown. The drawdown is the part that we need to talk about when we talk about growth stocks and comparing them to things like real estate. Okay, you have to understand what is the likelihood and risk of going down below your investment and time to remake for that investment. That's part of the equation, not just the up, but also the down. So if I plan on buying a piece of real estate and the price goes down some percentage, can I use those rents to accelerate my payoff? Can I refinance at some point? Do I have the ability to do more with the money that's tied up in the property? There's a lot more things you can kind of do with it. But it's not a fair comparison if you don't structure it in an apples to apples way. And apples to apples in this case means looking at downside and upside. Like, does that 20% plus per year include an 80% drawdown? And if it does, maybe that's a terrible way to play it. However, if you watch my other videos, a lot of times when I talk about growth stocks, I talk a lot about using things like stops or trails. This way you can protect your downside risk and not lose that money when things go down. So just keep that in mind as well. There's different ways to think about and structure it, but if it's not apples to apples, you're doing yourself a disservice and not really comparing things in a fair and equal way. Big Ray, I appreciate that. Thank you. So Jake, I haven't read this yet, but I can already tell it's going to be a good one. So Jake says, I'm 25, ready to buy my first house. Plan was to get a 3 to 4 bedroom and rent out the other rooms, then save from next property from there. Do you think now is a good time to buy or waiting 3 to 6 months? Yeah, Jake, first of all, man, like, congrats to you for already having a big brain here. Like, this is basically what we call house hacking, right? For anyone who's not familiar with that term. The idea is, how do we find a way to get into a property and then leverage that property to generate some sort of income or ability to sort of offset the mortgage. And that's exactly what Jake is talking about doing, right? A lot of people traditionally would do this by buying a 2, 3, or 4 family. You can still get an FHA low down payment loan. The way Jake's thinking about this is even simpler, really. Buy a single family, rent out the extra rooms. And in theory, those extra rooms are going to pay for his mortgage or close. Jake's going to then be able to save money for that next property, maybe take equity out of this property. Your specific question on the timing, I think it's really going to come down to looking at the data over the next couple of weeks here. Like, are we seeing home building increasing or slowing? Are we seeing rates steadying off or not? Are we seeing homes sitting in the market for longer periods of time? What I think you can do, and again, it's just my opinion. And in fact, I'm going to be honest with you, like, I'm in the market to buy a handful. It's a little more than that. I'm in the market to buy a portfolio by the end of the year. And I've already started going to all of the major players, telling them what I'm looking for. But my expectation is I want to be X% under where they've been, or go pound sand, I won't buy it. I think that even in looking at single families, what you're going to want to look at is a couple really simple things. Do we know what the comps are, and are they going down? How long are things sitting on the market? And if they've been sitting for a while, comps are going down, I think you can easily, Jake, go and make an offer that maybe is a little bit under asking. I don't think it's ever worth wasting people's time with the outrageous, like, 40% off prices and stuff like that for single families. But if you find something that you like, that you can rent those rooms out and you can get a pretty good price, I think you can probably play some ball here. But I'm going to say the same thing to you that I said earlier. Like, step one, you got to get that pre-approval and understand what you actually can buy, so you can go to the table as a serious buyer, so that when you ask for, them to pay closing costs, and you want to be, whatever, 15, 20K under asking, depending on the price, you want to make sure you can say, if you can do those things, I'm buying, right? That's what I'm going to do. Of course, you want to have your inspection and all those things, but the strength is what you bring to the table. And then the secret is what you know about what you can do after you buy. Your strength is the pre-approval in the data points. The secret is that you're going to rent those rooms out and get extra people to help you pay that. That's how I would approach it, Jake. Man, and I'll tell you what, like, I'm 39, man. I wish I was 25 with the way the market is right now. I'd have a house full of people renting bedrooms from me. For sure, that's how I would get my start. So I love the way you're thinking about it, man. Jackalope, happy Sunday to you too as well. Demon, no problem at all. So Drew, do you know how to invest in real estate from a Roth? This is a question, I'm going to be really honest with you, I'm not comfortable answering, because I don't know the real answer here. I'm not experienced enough in doing it in a Roth, and so I can't give you a good answer. I've heard of ways to structure it, but I don't have a good answer, Drew. I don't want to lead you the wrong way, so I'm going to leave it at that. And Dima, this is a great question too. So, does it always make sense to use leverage to buy a property? So I'm going to answer the question, like, with total sincerity and honesty here. I don't always use leverage when I buy properties. The last 2 houses I bought, I paid cash for. I saw, like, banging good deals, and I knew that I could get in, and I knew that I would have to act really fast. One I paid only $83K for, and it had a better than 1% a month return. It fit in with the 1% rule. The 1% rule is a rule a lot of investors use that says you want your your rent per month to be 1% of the total price. It's just like a rule of thumb. It's not a hard or like, don't buy the house if it doesn't fit this. But for a lot of investors who buy at scale, this is a good starting point. It fit that rule for me. And I also was aware that there was a hedge fund in the area who was looking to buy up a lot of homes, and I wanted to grab this. So I made a cash offer day of, said I could close in 2 weeks. So I did that. And then during COVID, I saw another property that I really liked that was way undervalued because they thought it needed way more work than it did. I'll just call this out too. I expect anytime I buy that I might have to go to the studs and do a full rip and replace of everything. So I start from the risk perspective of what I don't know, because if I have to act fast, I may not always use inspections. These 2 properties, I didn't actually use an inspection, but I have a really good team. So for me, that worked. For the average person out there, you should always be doing that. But does it make sense to always leverage? I think when you can, and we're in general sense, not financial advice, why wouldn't you use it if it's reasonable and the rates are decent and you can get a return on your money? It just makes sense to use it because you're going to have an arbitrage between what you earn and what the bank lends you, and someone else is paying it for you. To me, it's sort of a no-brainer. But if you have a specific example, happy to discuss it with you. Cool. So Amit, another good one here. Have you ever had tenants that didn't pay for multiple months? No, but I want to tell you why because I don't want anyone to think this is some BS sort of answer here. So I have a general rule that I'm not in this to make every penny of everything that I ever rent to someone. Okay, so I generally invest in affordable housing. My homes are generally in lower price areas, not bad areas, not like dangerous areas, but like lower income areas. So one of the rules that we sort of have had, I say weeks, I have some deals I have partners on, some deals I don't. Generally speaking, I want to be one of the nicest homes in the area from a standpoint of what we do to take care of it and the improvements we put in the home, but also one of the lowest price rents in the area. Not like low to be absurd, but if everyone else charges 1,400, I want to be at 1,300. And um, in my fund, just an example, it's a real estate operating company, an REOC. In case you're not familiar with the name, an REOC is what I run. We have not had more than 1 month of vacancy since 2015 across any doors that we own. And that's because we take really good care of our properties. We really keep the rents very reasonable so that people can afford to enjoy their lives and still live in a safe home. But the other thing as well is we buy really well on the front end, so we don't need to gouge anyone ever. And we go into this knowing we need to be affordable for folks right off the bat. We instruct our property managers that if there's problems, you can go ahead and fix them if they're under a certain dollar amount. So, like, we had an incident the other day where someone was backing up and broke a mailbox. Um, I don't even want to get a call about that. Send me an email that you're replacing a broken mailbox and send me a receipt or take it out of whatever. Good. Let's keep those tenants happy. A $30 mailbox is not worth losing someone for 2 months and $2,800 of rent that goes with it. So no, I haven't. But what I would say is if I did, this is exactly why I have that 5% a month that comes out to cover vacancies so that I'm totally protected in cases like this as well. I have so much spam coming through on my end. Yeah, Rizzy, I definitely do need a mod, but I don't even know how to do that. So maybe I'll ask you guys to help me with that. Um, our 10% down payment is normal these days. So let me. This is a really really great one. Um, our 10% down payment's normal these days. I think normal is the key word, is that nothing is normal anymore. But here's the specific answer to the question. If we're talking about commercial property or commercial residential, and to be clear, anything that is 5 units or bigger for apartments is commercial. That's a hard line. It's important to understand that, or else the conversation won't make sense. 1 unit, 2, 3, and 4, those are conventional mortgages. Anything above that, 5 and more, is going to be commercial. This could also mean like industrial space, office space, retail space, strip malls, whatever. Okay. So you're never going to get a 10% down payment on commercial ever. It doesn't exist unless maybe you find some weird hard money lender, but they're going to gouge you and you're going to end up losing that property. I'm not like, again, not financial advice, but I'm telling you, like, if someone's giving you a 10% rate on a 10% down on commercial, you're going to get screwed on that deal. Somehow, some way, you're getting screwed, and you should have an attorney and be looking at that paperwork right away. Now, 10% down on a 1, 2, 3, or 4. Oh man, but gosh, 10%. No, it's not normal. What's normal is 3.5%. There is a special program in the U.S. called the FHA program. It's a government program, and it allows you to put only 3.5% down if you're going to be living in the property. But they don't care if it's a 1, 2, 3, or 4 unit as long as you're living in one of the units. So one of the best house hacks that exists is to go out and put 3.5% down on like a 4-family, rent the other 3. You're gaining tons of experience in how to properly manage a home, manage tenants, and they're mostly going to be paying either the entire mortgage or even more, giving the ability to save towards sort of the next thing you want to do. So 100%, you do not need to put 10% down. Of course, the caveat will be you're going to probably have some PMI or private mortgage insurance. So that's going to be a little bit of a pain in the butt, but that will drop off once you hit 20% or so, give or take. So yeah, like 300% down should be your starting point, but this is also the reason you should be going and getting pre-approved to understand what programs you can fit into. I want to add though, if you're a veteran, you can go into a 0% down payment program. Those exist for veterans, 3.5% down for everyone else. There's even programs called USDA loans. I'll let you guys Google these. A USDA loan is 0% down in rural areas. But the thing is, and you might be surprised by this, you might live in a rural area per the government, but not realize it. Where I live right now, as I'm recording this video, is considered a rural area. It is not a rural area. It may have been 15 years ago, 20 years ago, but it certainly isn't anymore. But those maps don't update very often. So that's another way to think about getting into something for a very low down payment or no down payment. Okay, great question. Jake, yeah, no problem. Thanks for asking the question. Okay, Drew, is it ever a good idea to buy a rental by leveraging your own residence? I hear this question all the time, team. And I'm going to give you my genuine advice here. I do not ever, ever mix my personal with my business. Now, there's going to be a lot of people who think I'm wrong on this. They're going to tell you, nope, go get a HELOC, a home equity line of credit. You can use that to buy your first rental property. For me, the stress of knowing that my personal residence is completely walled off, safe, cannot be taken away no matter what happens on the other side of it, lets me sleep at night. Yes, I could pull equity out and pick up a couple more doors for sure. But is that worth it to me to know that, God forbid something happened, I could be at risk of my own home or have the stress that comes with that? For me, it's a no. Could you do it? Sure. Is it a good idea? To some people, maybe. To me, it's definitely not a good idea. And I also like to know that, my kids or my wife or anyone else in that matter doesn't have to be worried about what's happening with the primary residence if there was ever some sort of a lien or a lawsuit or things like that. So just general opinion, not advice there, but that's my take on that. And then I think this might be the last question. And if so, then I'll wrap it up here. But Rizzy again says, a realtor was telling me 20% on a single family home. So let me talk about this real quick on why I think this might be the case, but it is definitely not the case. Where real estate has been so unbelievably competitive for the past couple of years, and especially the past couple of months, we're seeing that people who are coming to the table with larger pre-approvals, more money down, more ability to close quickly, less contingencies, those are the deals that are winning the bids. I have a buddy who's a realtor. We actually own some properties together. He was just telling me the other day that he's already starting to see things slow down. People are asking for contingencies again. My advice, I'm sure your realtor is great. But I would understand why the 20%, because that is certainly not the case. And if it's for you to live in and you don't mind paying the PMI, which is no big deal anyways, I would rather put as little money down as humanly possible, as long as I feel like I'm getting a good deal in the house. Because you can always pay more every month to lower your mortgage down and to lower your overall loan down. But my general feel is the less I can put down, the better. And that's with all things, because this is where the ability to leverage the bank's money really comes into play. Because when you get those returns, when the home prices go back up again, however long that takes, that's where you make your bang for the buck. Again, that's just my 2 cents. I'll give you an example. Like if I can get a loan even under 5%, I'd rather take any other money at 5%. I can beat that almost anywhere, right? You can go in the stock market, you can buy investment property, you can do a lot of things and beat 5%. Okay. I'm not saying like, here's the things I would do, but the question is, you can either take your money and put it into your home to stop yourself from paying a 5% mortgage or less, or you can take that extra cash and put it into something else to earn more with it. I prefer to try to earn more with it when it comes to a situation like this. That's my 2 cents. Cool. So team, I think we went for almost 45 minutes here. I'm so excited that you guys came with so many questions. I would like to do this on Sunday mornings, probably a bit earlier than I did it today. And I'll look to do this again. So really appreciate the questions. I can cover a lot of material and complexity here, or keep it really simple. So if you hit me up on Twitter and tell me things you liked, you didn't like, or you would like me to go deeper on, feel free. I can also come prepared next week, talk more about the different way we look at ROI within this space as well. So keep that in mind. So with that, I just want to say a big thank you to everyone for jumping on. I gave you guys a 5-minute notice, by the way. So really thank you so much for jumping. I hope you have a great Sunday. Have a good week of work. And otherwise, I'll see you. And thanks so much for joining. Thanks, everybody.